Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing high-tide stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a micro-cap company, 160 million market cap. They're trading at $2 a share, and they have 79 million shares outstanding. HITI is a Canadian cannabis company. They are a fully integrated cannabis operation. They have brick and mortar retail stores, a large e-commerce platform. They sell cannabidiol. That's more for medicinal purposes. They sell cannabis wholesale. They also do licensing. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They report all their numbers in Canadian dollars. When we look at their financials later, it'll be in Canadian dollars. But we're looking at the ticker that trades in the US, so I converted all their numbers to US dollars. So my Excel spreadsheet is US dollars. They did have negative free cash flow in 21 and 22, positive in the trailing 12 months, positive 11 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's negative every single year. Revenue is a sales for the company, and that doubled from 2020 to 2021, almost doubling again into 2022, up 37% into the trailing 12 months. Not a lot of revenue, but at least they're growing. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 300 million. We discounted those numbers back to today using the weighted average cost of capital. Their WACC is pretty high at 10.8%. We get a value of the company of $244 million. We divide that by 79 million shares. And we get a calculated stock price of $3. They're trading at $2, so they're trading at a 34% discount. It is a buy according to the model. The stock has come down so much the past few years. And it doesn't look like the company's going to go bankrupt, so it should go up at some point. You just don't know where the bottom is. And they're in a really tough industry. A lot of people don't like what they do. And the product is illegal in the US on a federal level. It is legal on a state level in certain states. They did get a boost in Germany. Germany just legalized marijuana on a federal level. Canada has been legal for quite some time. But if the US legalizes it, the stock will go through the roof, guaranteed. There are 8 companies in the same industry as HITI, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. The industry they're in is pharmaceutical retailers. It is futile comparing them to other companies in their industry because they're so different. So if you just want to focus on their numbers, I don't blame you. They don't spend much in CapEx, only $6 million. A good debt to equity ratio, 0.5. For every dollar of equity, they have 50 cents of debt. They do not pay a dividend. They are generating positive free cash flow, which is really good. A tiny market cap, 160 million. Their price to book looks pretty good at 1.1. Price to free cash flow is decent at 15. They're trading at 15 times free cash flow. A great price to sales, less than 1/2. If their price to sales was 0.5, that means their revenue will be double their market cap. Since it's below 0.5, their revenue is more than double their market cap. I do not see the US legalizing cannabis on a federal level anytime soon. But if they move it from Schedule 1 to Schedule 3, that could really benefit this company. And that is a possibility. Here's an article from August 2023, so less than a year ago. The Department of Health and Human Services is recommending to the DEA that marijuana be rescheduled from Schedule 1 to Schedule 3. Schedule 1 are drugs with no accepted medical use and a high potential for abuse. That includes heroin. So heroin is in the same category as marijuana, which does not make sense, because there are medical benefits for marijuana. Sure, people take advantage of anything. There's a lot of people who use drugs that are meant to help people, but they use it to just enjoy life. But you can't get around that. People will always take advantage of things. That doesn't mean marijuana belongs in Schedule 1. Schedule 2 is drugs with a high potential for abuse, leading to physical dependence. And that includes meth, cocaine, oxycodone, fentanyl, which kills so many people. So marijuana is worse than fentanyl according to the schedules, because Schedule 1 is the worst. Schedule 3, which is where the drug should be, These drugs have a low potential for physical and psychological dependence. Drugs in this category are Tylenol with codeine, ketamine, testosterone. Just moving from Schedule 1 to Schedule 3 will lead to more opportunity for people to buy the drug in the US on a federal level and in certain states. Schedule 4 is low potential for abuse and low risk of dependence. This includes Xanax, Valium, etc. Schedule 5 is the least dependent. This includes Robitussin. Let's take a look at their most recent financials. This is as of January 31st, 2024. We'll start with the income statement. For the trailing 3 months, the 3 months ending 1/31/2024, revenue of $128 million. That is up from $118 million in the 3 months ending January 31st, 2023. So a little bit of growth, not that much. Let's see if they give a breakdown of the $128 million. Remember, these are in Canadian dollars, not US dollars. So if you want to convert to US, it's about 75% of these numbers. Most of their revenues in Canada, $115 million. 12 million in the US, which is down from 17 million last year. But their revenue in Canada is up more than the decline in the US. So that's why their revenue went up. International revenue is also down 1.2 million to 550,000. Of the 128 million, 109 million is cannabis and CBD products. CBD is the chemical found in marijuana, but it's the part that doesn't make you high. The THC makes you high. CBD is to make you mellow, and it also has some medical benefits. They also sell things like gummies, consumption accessories, 11.4 million. They have data analytics services, 7.3 million. Their revenue is up 9% when you compare 1Q 2023 to 1Q 2024. Gross profit is up 12%. Gross profit is 36 million compared to 32 million last year. Gross profit margin's up a bit from 27% to 28%. This means they converted 28% of their revenue into gross profit, but their operating expenses are kind of high, 33 million. Last year, 36 million. So they do finally have positive operating income, positive 2.8 million compared to a loss of 3.9 million. Also, they have positive free cash flow, 3.6 million. Last year, they had negative free cash flow. So their EBITDA almost doubled. Last year, 5.5 million. This year, 10.4 million. So they're doing a really good job at becoming profitable. They still have a small net loss, though. A net loss of 5,000, but a lot better than last year. They had a net loss of 3.9 million. Here's a breakdown of their revenue again, but in percentages. So cannabis and CBD products up 12% from last year. Consumption is down. It's down 18%. I wonder why that is. Data analytics is up 11%. Other is up 275%. So their total revenue is up 9%. 90% of their revenue is retail, brick and mortar. 10% is online. Let's look at their balance sheet. Let's make sure they have enough cash runway. Current assets, 65 million. Current liabilities, 58 million. So they have enough liquidity to get through the next 12 months. 29 million of cash. 25 million of inventory. Here's a breakdown of the inventory. Most of it is finished goods, 25 million. They do have a small amount of raw material, 771,000, and work in process, 84,000. Their total assets, 227 million, down from 233 million. Their biggest asset is goodwill. It looks like they do a lot of acquisitions. Here's a breakdown of the 99 million. 76 million is goodwill, 9 million is brand names, licenses 10.6 million, and software 4.5 million. Here's a recent article. They completed their acquisition of the brand Queen of Bud. Queen of Bud sells products in the Canadian market to consumers and also through third-party licensed cannabis stores. It looks like they're paying $1 million for the acquisition, $900,000 of stock, $100,000 of cash. Let's go back to the balance sheet. Their total liabilities, $87 million. That's down from $99 million. Their biggest liabilities, lease liabilities. These are the leases for the retail stores they operate in. Assets minus liabilities equals equity. 140 million of equity, up from 133 million. They raised 300 million from selling their business, and they lost 200 million from running their business. Accumulated deficit is the sum of their prior net incomes. Let's take a look at their statement of cash flows. Operating cash flow, 7 million. Last year was 2 million. The main reason they have negative net income and positive operating cash flow is because of all the depreciation amortization, nearly $7 million. Last year, almost $8 million. In their investing section, they spent $2 million of PP&E. Last year, $1.4 million. In their financing section, they paid back $3 million of debentures. Debentures are unsecured debt issued by HITI. They also paid back $2.8 million of lease liabilities. And it doesn't look like they're adding any equity, which is good. Only $3,000 in this quarter. Last year, they added $1.9 million of equity. ATM is at the market offering. So that means they issue shares at the market at the current market price. Here's a list of all their subsidiaries. Canna Cabana, a Canadian company, they own 100%. So the first 10 are Canadian companies. Look at that, they own Meta. You think their stock price will be a lot higher. Obviously, this is not the real Meta. It's Meta Growth, a small cannabis company. High Tide BV, that looks like a European company. Then some US companies, Valiant, Small Cartel, Fab Nutrition. A UK company, Enigma, they own 80% of that company. They list some business combinations, some acquisitions. In December 2022, they acquired 100% of Jimmy's Cannabis Shop, which operates 2 retail cannabis stores in British Columbia, Canada. I guess that acquisition is for $5.3 million. They gave Jimmy's 4.9 million shares of stock, and this is what they received. They received cash, inventory. Most of what they received is goodwill, $3.4 million. Goodwill is just a plug. It's a useless asset. For the most recent year, Jimmy's had $4.7 million of revenue and a $203,000 net loss. All their Canadian revenue is brick and mortar. All the US and international revenue is online. They don't have any brick and mortar shops in the US. Their operating income from the brick and mortar locations is $3 million. Last year they had an operating loss of $4 million from brick and mortar. And they're losing money in e-commerce. They lost $163,000. Last year they lost $55,000. They do have positive gross profit in e-commerce, but their operating expenses are higher than their gross profit. That's why they have an operating loss. Operating expenses is marketing and payroll for certain employees. Here are some of their bigger brands. Canna Cabana, Fast Ender, Grass City, Smoke Cartel, Daily High Club, Dank Stop, Fab CBD, Blessed CBD, and New Leaf Naturals. Here's a breakdown of their operating expenses in case you were curious. This is for the most recent quarter. Salary $16 million, stock-based compensation $800,000, general and administrative $5.6 million, professional fees like legal fees $2 million, advertising $800,000, depreciation $6.8 million, and interest and bank charges $1.2 million because they need to pay interest on the loans they take from banks. This blue line is their quarterly revenue for the past 8 quarters. It looks like it grew nicely in 2022, but pretty much flat in 2023. Adjusted EBITDA looks pretty flat. It's hard to tell on this chart, but at least it's positive. Here's the net loss the past 9 quarters. They had their smallest loss this quarter. It looks like in the fourth quarter they tend to have a big loss due to the holidays maybe. EBITDA is positive every quarter except the fourth quarter. They usually have a big loss. But adjusted EBITDA is positive every quarter. They had the highest ever in this quarter. They also had a good quarter in Q3 2023, $10.2 million. Operating cash flow is always positive. That's a good sign. Free cash flow has been positive the last 3 quarters. Last quarter, Q4 2023, was the highest, $5.7 million. Let's take a look at the stock on Simply Wall Street. Its last price, $2, 157 million market cap, up 10% in the past week, up almost 50% in the past year. Let's see what they say about the company. HITI is a cannabis retail business in Canada, the US, and internationally. The company operates through retail and wholesale segments. It operates licensed retail cannabis stores and provides data analytics services. In addition, the company manufactures and distributes consumption accessories. It sells its products through online sales via e-commerce. The company offers its products under the Daily High Club, Dank Stop, Fab CBD, New Leaf, Smoke Cartel, and Blessed CBD brands. They were formerly known as High Tide Ventures and changed its name in 2018. They were founded in 2009, headquartered in Calgary, Alberta, Canada. It looks like they started trading in 2019, and they did fall to below $1 in March 2020, and then when Biden got elected, cannabis stocks went up a ton. It peaked at $12 in 2021. come down a lot since then. It fell to about $1 March 2023. It's up a little bit since then. They did do a 1 for 15 reverse stock split in May 2021, so they wouldn't get delisted. So it looks like in May the stock was at 50 cents. Then they do the 1 for 15 reverse split. It came up to about $8. Simply Wall Street values the company at $11. They say it's 82% undervalued. 5 analysts priced this stock at $4.39. They also say it's undervalued. Their revenue is projected to be over $500 million in 2024. That's 500 million Canadian dollars. 600 million in 2025, 749 million in 2026. Their free cash flow is projected to be 5.3 million in 2024, 17 million in 2025. Look how low their revenue was in 2016, only 8 million. It went from 10 million in 2019 to 40 million in 2020, a 300% growth. Over 100 million in 2021, over 200 million in 2022. It keeps doubling, over 400 million in 2023. And 2024, 500 million for the trailing 12 months. They were debt-free in 2018. Their debt peaked at 55 million in 2021. It's currently 29 million. And their equity is a good amount higher than their debt. Equity of 140 million, debt of 29 million. And they do have enough cash on their balance sheet to pay down all their debt. Their cash is pretty much equal to their debt. The CEO's salary in 2018 was $250,000. Up to $550,000 in 2023. Total compensation $1.7 million. Tenure as CEO over 6 years. In the past year, there's been mostly insider buying, only one sell. So you can see about 135,000 insider shares have been purchased in the past year, only 8,000 sells. 83% of the company is owned by the general public, 9% by insiders, and only 8% by institutions. The biggest shareholder is the CEO at 8.5%. Then Title Investments 3%. I do know RBC, Royal Bank of Canada, one of Canada's biggest banks. I've heard of Murray Asset Global. I also heard of Susquehanna, Geode, BMO, Bank of Montreal. Their employee count is up a little bit from 1,000 in 2021 to 1,400 currently. It did peak at 1,600 in October 2023. It's down 200 since then. And the ticker trades on the NASDAQ, TSX Venture, and Deutsche Börse. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.